In the world of finance, there's this invisible force. It's executing trades at the speed of light, moving trillions of dollars around the globe every single day. We're talking about algorithmic trading. It's an absolute marvel of technology that has completely changed the game, but it also makes you stop and ask, is it fair? Is it even safe? And really, who's actually in control here? Take a look at this number, 70%. That's the percentage of all stock trades in the US that are now done not by humans, but by computer algorithms. Yeah, you heard that right. The machines are pretty much running the show now. And that, right there, is the big question, isn't it? It's the central conflict we're digging into today. Are these lightning-fast, super smart programs actually creating a better, more efficient market for all of us? Or are they just rigging the game for a handful of players with the fastest computers and the deepest pockets? So let's pull back the curtain. Let's really get into what happens when the code takes over. So what exactly is algorithmic trading? Well, at its core, it's about using computer programs to make trades at speeds that are just completely superhuman. These programs can scan through mountains of data, spot tiny patterns, and fire off orders based on a set of rules, all in a matter of microseconds. It's a whole different ballgame. Now, on one hand, the folks who love this stuff, they've got some pretty strong arguments. They'll tell you that all this high-speed action adds liquidity, which basically makes it easier for you to buy or sell a stock whenever you want. It also shrinks the bid-ask spread, that's the tiny gap between buying and selling prices, which saves investors like you and me money on every trade. It can even give smaller investors access to automated strategies that used to be only for the big dogs. And listen, this isn't just some theory. The data shows that high-frequency trading has helped slash those bid-ask spreads by a whopping 50% since 2008. That's not just pocket change. We're talking billions in savings for big investors like pension funds. Okay, so it all sounds great, right? Cheaper, faster, better for everyone. So what's the catch? Well, the downside, the real problem, lies in the very thing that makes it so powerful in the first place. Its incredible mind-bending speed. And that brings us to this obsession, the need for speed. In today's markets, we're not talking about minutes or seconds anymore. It's a game of microseconds. This slide just lays it all out, doesn't it? A really fast human trader might react to some news in a couple of seconds. An algorithm? It reacts in microseconds. That's millionths of a second. To put that into perspective, there are more microseconds in one single second than there are seconds in an entire day. It's a completely different reality. Now, to win at this game of speed, firms will do just about anything for an edge. And the ultimate edge is something called co-location. It's literally paying a fortune to put your computer servers in the exact same building as the stock exchange's computers. Why? Because it shaves a few milliseconds off your travel time. And in this world, a few milliseconds is like being able to see into the future. And that front row seat does not come cheap. We're talking up to $50,000 a month. And that's just for one exchange. It creates this massive barrier to entry. Speed is literally for sale to the highest bidder. And this is where we get to the heart of the ethical debate, right? Is this fair? When you can buy an advantage this huge, this powerful, can you really call it a level playing field? Just look at this. This chart, wow, it tells a powerful story. The top 10 high-frequency trading firms are capturing around 60% of all the profits in U.S. stock trading. A tiny handful of elite firms are reaping almost all the rewards, all thanks to their technological head start. This brings up a really deep question, and it's captured perfectly by this idea from the philosopher Michael Sandel. Should the rewards in our markets go to people for their skill, for their insight, for taking a risk? Or should they just go to whoever can afford the fastest fiber optic cable? Is that really what we mean by merit? The speed advantage also opens the door to some pretty shady stuff, outright manipulation. You have tactics like spoofing and layering. It's basically placing a ton of buy or sell orders that you have no intention of actually following through on. The only goal is to trick other traders and their algorithms into thinking the market's moving, so you can profit off their reaction. It's like creating a phantom army. And what makes this so incredibly hard to police is something called the black box problem. These trading algorithms are top secret, multi-million-dollar assets. Regulators often can't even see the code, so it's almost impossible to prove if a weird series of trades was a deliberate trick or just some quirky, legitimate strategy. But it's not always about cheating on purpose.
What happens when these incredibly complex, interconnected systems just mess up? When the robots go wrong, who pays the price?
Well, this is exactly what happened during the infamous 2010 flash crash. It was nuts. A single large automated sell order started a domino effect, a chain reaction among all the other algorithms. And in just a few minutes, the market vaporized $1 trillion in value before, just as mysteriously, snapping right back. It was a terrifying look at how fragile the whole system can be.
Or how about this one? Knight Capital. Back in 2012, a single coding error, a typo in a new algorithm, caused it to go completely haywire. It lost $460 million in just 45 minutes. Poof, gone. One tiny bug almost bankrupted a major company.
So, when a disaster like that happens, who do you blame? The programmer who wrote the bad line of code? The executive who rushed the rollout? The firm itself? Or maybe even the AI? This is the messy philosophical problem of distributed moral responsibility, where the blame gets spread so thin that it feels like no one is truly accountable. Okay, I know all this talk of crashes and manipulations sounds pretty bleak, but the good news is it has kicked off a huge global conversation about how we can get the benefits of this tech while, taming the risks. So let's look at the search for solutions.
There are a few big ideas floating around. Some people talk about a Tobin tax. Think of it as a tiny tax on every single trade, just to make those super high-frequency strategies a little less profitable, to slow things down. In Europe, they already have regulations that force firms to test their algorithms like crazy to prevent errors. And, looking ahead, some people are saying we need to force these firms to open up their black boxes and create more transparency.
At the end of the day, it really is that classic double-edged sword, isn't it? On one side, algorithmic trading is this incredible engine for efficiency, driving down costs. But on the other, it introduces these massive risks to fairness, to transparency, and to the stability of the entire financial system. And that leaves us with the big one. These algorithms, this AI, it's only getting smarter and more powerful from here on out. And the question we all have to answer is, are we building this technology to serve the broader goals of society, or are we just creating a system that subverts it for the benefit of a select few?